Welcome to Talk Tickers. Today, we're digging into Apogee Enterprises, ticker APG, and figuring out what on earth happened on their Q3 earnings call. Let's jump right in. So this is the number that just smacked investors right at the open, a drop of nearly 17%. Ouch! So what could possibly cause a reaction that's severe? Well, let's unpack this quarter. All right, let's start with the surface story, because when you first look at the Q3 numbers, they seem fine, kind of mixed, maybe a little confusing, but definitely not a down 17% kind of disaster. And that's really the core of the mystery here. Take a look at this. On one hand, you've got adjusted earnings per share coming in at $1.02. That's pretty much right on the money, even a slight beat versus what Wall Street was expecting. But then you look at revenue, and whoa, that $348.6 million was a pretty big miss. But here's where it gets really interesting. You gotta look under the hood. So yeah, they technically eked out a tiny bit of revenue growth, just over 0.5%. But look at where it came from. Their actual core business, it shrank by over 3%. The only reason the top line was positive at all was because of a recent acquisition they made. That's not a great sign. So why the huge sell-off if the quarter itself wasn't a total train wreck? Well, it's the classic story, right? The market doesn't really trade on what happened yesterday. It trades on what's going to happen tomorrow. And boy, did management just torpedo those expectations. And this right here is the smoking gun. Management absolutely slashed their full-year earnings guidance. But the really killer part? Look at the dates. They had just reaffirmed the higher numbers about 2 months ago. To do a 180 that fast, that just screams that something is wrong, and it really, really hurts their credibility with investors. So what was the reason? Well, according to management, it was basically a perfect storm of bad news hitting them all at once. You've got new tariffs coming out of China, you've got competitors putting on some serious pricing pressure, aluminum costs are on the rise, and maybe most importantly, their project backlog is shrinking. That means less work lined up for the future. And just to put one of those things into perspective, look at the tariffs. We're not talking about a small impact here. Those new duties alone are expected to knock a full 30 cents off their adjusted earnings per share for the year. That is a massive direct hit to the bottom line. Okay, let's switch gears and talk about the actual earnings call, because there's this really fascinating disconnect between what management was saying and what the numbers were showing. If you listened in, the message was all about execution. You heard phrases like disciplined execution and the strength of our culture over and over again. They were really trying to paint a picture of a well-run ship. But then you look at the data from their most important segments, and it tells a completely different story. I mean, look at this. Architectural metal sales down almost 10%. Architectural glass down over 4%. And the scariest one, their services backlog, that's their book of future business, is down over 11%. That doesn't really line up with disciplined execution, does it? And you can't just blame the market for this one. It's not like everyone in their space is suffering equally. Just look at this comparison. Over the last year, this sector ETF is basically flat. Apogee, down more than 44%. That pretty clearly tells you these are Apogee-specific problems. All right, so let's put it all together. What's our take on Apogee going forward? What should we be looking for on the next earnings call? So, we see this playing out in 3 stages. First, the next quarter's results. We're expecting to see those margins get squeezed even more from those rising costs and all that competitive pressure. Second, the stock itself. Best case scenario, it's probably stuck in a range. More likely, though, we think it's going to test new lows until the company can show us a real, data-driven turnaround, not just talk about one. And all of that, of course, brings us to our official rating on the stock. We're starting our coverage on Apogee with an underperform rating. And look, the main reason is simple. When you slash your guidance so dramatically, just weeks after confirming it, you burn through your credibility. It becomes really hard to trust what management is going to say next. And that leaves every investor with one critical question, right? Is this new, lower guidance the absolute floor, a one-and-done reset? Or is this just the first of many cuts to come? And honestly, the answer to that question is going to decide where this stock goes from here. This is not financial advice.